Today, we're diving deep into a concept that has been a cornerstone for retirement planners: the 4% rule. Ever thought about how much you'd need to retire comfortably? Or wondered how experts determine safe withdrawal rates from retirement funds? We've got you covered. Throughout this video, we'll untangle the history, the math, and the practical implications of this fascinating rule. So grab your notepads because this one's packed with information. At its core, the 4% rule is pretty straightforward. Imagine for a moment that you've managed to save up a whopping $1 million for your retirement. Quite the accomplishment. Now, according to the 4% rule, in the first year of your retirement, you can safely withdraw up to 4% of that amount, which is $40,000, without severely risking depleting your savings prematurely. Sounds simple, right? But here's where it gets a tad more intricate. From the second year onward, you won't just stick to withdrawing $40,000. Instead, you'd adjust this amount based on the inflation rate. So, if inflation is at 2%, your next withdrawal could be $40,800. On the flip side, if there's a rare decrease in prices, say of 2%, you'd pull out slightly less, coming to around $39,200. The essence of this rule is to maintain your purchasing power throughout retirement. Before we continue further, let's address a common myth first. It's not about withdrawing 4% every single year. That 4% is just for year one. Afterwards, inflation becomes your guiding star. But we will touch more on that later. First, let's explore the roots of this fascinating concept. Ever wondered who's the mastermind behind the 4% rule? It's William Bengen, a financial planner who made groundbreaking strides in the retirement planning arena. In the 1990s, Bengen embarked on a meticulous study examining retirement spanning a 50-year period from 1926 to 1976. He leaned into actual market returns from 1926 to 1992, and for the subsequent years, he made some educated assumptions about returns. What's remarkable is the lengths Bengen went to validate this rule. He simulated the sustainability of portfolios across varied starting points. For instance, how a portfolio initiated in 1926 would fare till 1976. For those kick-starting their retirement in 1976, he projected its longevity till 2026. The results were nothing short of illuminating. An initial withdrawal rate of 4% saw most portfolios lasting 50 years or more. And here's a stat that will impress. Even for those few portfolios that didn't hit the 50-year mark, they still survived a commendable 35 years. Interestingly, while Bengen's research gave birth to the term the 4% rule, he himself didn't coin it. It emerged from the community that was inspired and enlightened by his findings. His work, in essence, showed that for the majority of retirees, a 4% withdrawal rate ensured not just surviving, but thriving throughout retirement. Before we jump to the next segment, here's a little food for thought. If you had to suggest an alternative percentage for safe withdrawals, what would it be and why? Drop your thoughts in the comments below. All right, folks, let's delve deeper into the intricacies of the 4% rule, shall we? To begin with, the rule is underpinned by the philosophy of preserving capital. In the world of retirement planning, this means ensuring that your portfolio remains largely intact, providing you a steady flow of income while also accounting for the ups and downs of the market. The mechanics of the rule can be distilled into this principle. In the first year of retirement, you'd withdraw 4% of your portfolio's total value. Subsequent annual withdrawals are adjusted for inflation to maintain purchasing power. For instance, if you have a $1 million portfolio, you'd withdraw $40,000 in year one. If inflation that year is 2%, the next year you'd withdraw $40,800. But here's where things get really interesting. This isn't just about crunching numbers. The 4% rule also factors in market volatility and how different sequences of returns can affect one's portfolio. A study by Trinity University in 1998 supported Bengen's findings, suggesting that a portfolio composed of 50% stocks and 50% bonds had a 95% chance of lasting 30 years using the 4% rule. Such statistics underline the reliability of this approach, especially when seeking a balance between risk and security. Yet, like every financial strategy, it's not one size fits all. While the 4% rule provides a foundational framework, it doesn't account for personal variations in retirement goals, health conditions, market conditions, or the potential of receiving other income, like inheritance or rental incomes. Moreover, global economic shifts, like the recent pandemic, can shake up these predictions. This segues into a crucial takeaway. Financial strategies, including the 4% rule, are valuable guides, but they should be tailored. Relying solely on it might mean you could miss out on maximizing your portfolio's potential. Diversifying investments, exploring alternate withdrawal rates, and being proactive about reassessments are essential. Now, for those of you who are eager to see this rule in action, let's walk through a concrete example. It'll give us a clear picture of how this strategy might play out in real-life scenarios, especially when applied to average retirement portfolios. Let's consider Jane. Jane has recently retired at the age of 65, and her portfolio's total value stands at $430,000, which, interestingly, is pretty close to the average retirement savings for many individuals in her age group. If Jane were to implement the 4% rule, how would it look for her? In the first year of her retirement, she would withdraw 4% of her portfolio's value. This would amount to $17,200, $430,000 times 0.04. This is the money Jane would use to cover her living expenses for the year, combined with any other income she might have, such as Social Security. Now, moving on to year 2. Suppose the inflation rate that year is 2%. Jane would adjust her withdrawal to account for this inflation. So she'd withdraw the initial amount, $17,200, plus an additional 2%, which would be $344. This brings her second-year withdrawal to $17,544, and each subsequent year would follow a similar pattern, adjusting for inflation. This approach allows Jane's remaining portfolio to continue growing, albeit at a potentially reduced rate due to the withdrawals and market conditions. By following the 4% rule and adjusting for inflation, Jane aims to ensure her savings last throughout her retirement. However, it's vital to remember the inherent uncertainties in any financial strategy. Market downturns, unexpected expenses, or personal emergencies might necessitate adjustments. It's where having a financial cushion or alternate income streams can make a world of difference. To underscore the importance of continuous assessment, let's say that 5 years into her retirement, a major market downturn reduces Jane's portfolio by 20%. This would obviously have implications for her withdrawal strategy, and she might need to consider recalibrating her annual withdrawals or finding supplementary income sources. In essence, while the 4% rule offers a straightforward guideline for Jane, and for many like her, the real-world application demands flexibility, foresight, and periodic evaluations to ensure that one's retirement funds stretch as far as they need to. Stepping away from the static nature of the 4% rule, it's time to delve into the realm of dynamic withdrawal rates. While the 4% guideline provides clarity and simplicity, it's not always the best fit for everyone, given the ever-evolving financial landscape and personal circumstances. Dynamic withdrawal strategies, as the name suggests, allow for adjustments in the annual withdrawal amount based on a combination of factors: market performance, remaining life expectancy, and any changes in personal financial needs. This dynamic nature provides an edge, especially when navigating the unpredictable waves of the financial markets. Let's consider some data to support this. A study by Michael Kitches highlighted that using a dynamic strategy can lead to a significant reduction in the possibility of portfolio depletion over a 30-year retirement period. While the fixed 4% rule holds its ground in stable or bullish markets, during extended bear markets, dynamic adjustments can be a lifesaver, potentially adding years to the longevity of one's portfolio. Take the case of Tom, who retired in the late 1990s. Had he strictly adhered to the 4% rule, the dot-com bubble's subsequent crash could have severely impacted his retirement funds. But by incorporating dynamic withdrawals, Tom could reduce his withdrawals during the downturn, preserving his portfolio. When the market rebounded, he adjusted again, increasing his annual withdrawals. It's like adjusting the sails of a ship based on the wind's direction. While the 4% rule offers a set-it-and-forget-it simplicity, dynamic rates are akin to an experienced sailor reading the winds and adjusting accordingly. It's crucial, though, to recognize the challenges that come with this flexibility. Dynamic strategies require frequent reviews, perhaps even annually, and the discipline to decrease spending during market downturns. But for those who value adaptability and aim for a more hands-on approach to their retirement strategy, the benefits of dynamic withdrawal rates might just outweigh the added complexities. The 4% rule has been a cornerstone of retirement planning for decades. But in a world of shifting economic landscapes, low interest rates, and unpredictable market behaviors, one might wonder, does this rule still hold its ground in the modern era? Historically, the 4% rule was based on an average stock market return of about 7% annually, accounting for inflation. However, with the current climate of low interest rates, achieving this average becomes increasingly challenging. Vanguard, a global investment giant, recently predicted that over the next decade, U.S. stock returns might average around 4% to 6%, considerably lower than historical standards. Furthermore, longer life expectancies mean retirement funds must stretch further than before. With advances in healthcare, a retiree today might expect to live into their late 80s or even 90s, extending the duration their portfolio must support them. In light of these shifts, while the 4% rule can serve as a useful starting point, it's crucial to recognize its limitations. Modern retirement planning should perhaps adopt a more flexible approach, embracing both static rules and dynamic strategies to navigate today's unique challenges. Now, if you want to learn more about the important retirement planning questions that you should be asking yourself, we have a separate video dedicated to this entire topic in even more depth, so watch this video next.